Good evening, everyone, and welcome to the episode 12 of Alternate Universe webinar series. In today's session, Sectors to Watch and Dodge, we explore the evolving dynamics across India's equities landscape, where we will spotlight the sectors poised for structural growth, decode emerging trends shaping performance, and identify areas facing short-term challenges. Plus, we will dig into contrarian opportunities that others might be missing. So get ready for a session full of sharp insights and actionable takeaways. For that, today we have two very special guests. First, Mr. Darshan Engineer, Fund Manager at Sundaram Alternate Assets. Mr. Darshan is an experienced investment professional with over 16 years of experience in financial markets, including 14 years in equities and 2 years in credit rating. His investment career spans across leading PMS and AIF platforms such as Alchemy Capital, Karma Capital, and Valuequest investment advisors, with a focus on smaller mid-cap strategies. He also held leadership roles in credit research during the later part of his stint at CRISIL. Known for his strong bottom-up research capabilities, Mr. Darshan brings deep sectoral expertise across consumer discretionary, auto and auto ancillaries, pharmaceuticals, chemicals, and information technology. He holds an MBA in finance from Jamnalal Bajaj Institute of Management Studies and a computer science engineering degree from Mumbai University. Welcome, sir. Next, we have Mr. Sandeep Tulsian, Fund Manager at Sundaram Alternate Assets. Mr. Sandeep is a seasoned investment professional with over 17 years of experience in equity research and portfolio management. His sectoral expertise spans capital goods, defense, consumer durables, cement, and auto ancillaries. Before joining Sundaram Alternates, Mr. Sandeep played a pivotal role at JM Financial, where he contributed to several marquee capital market transactions, leveraging his extensive corporate network and deep understanding of the investment landscape. Recognized for a strong analytical acumen, Mr. Sandeep has been consistently rated among the top analysts in the Asia Pacific region for alpha generating investment ideas. He holds an MBA in finance from Enel Dalmia Institute of Management Studies and a BCom degree from University of Mumbai. Welcome, sir. We have Mrs. Reshmi Chakravarti from Sundaram Alternate Assets. Mrs. Reshmi is a seasoned investment professional with over 19 years of experience in the financial services industry. Currently, she is serving as Area Sales Manager at Sundaram Alternates, where she handles the national distributor and banking channel. Her previous career spans several reputed institutions like Aditya Birla Capital, HDFC Bank, Shriram Life Insurance, and Aviva India. Welcome, ma'am.
Thanks, Arvind. Thanks for the lovely note. Good evening, viewers, and welcome Sandeep and Darshan once again on the show. Speaking about ourselves, Sundaram Alternates is a part of Sundaram Finance Group, which is one of India's largest reputed and known NBFC, spanning more than 7 decadal presence. At Sundaram Alternates, we manage more than 7,000 crores of assets, mandates of equity and credit funds both. Our equity strategies have a pedigree, more than 10 years of track record generating significant alpha over benchmark since inception. However, we urge all our investors to be invested with us after consulting their respective planners before investing. Now, without further ado, I would like to take this show forward. And my first question is to you, Sandeep. With the evolving macroeconomic signals and shifting investor sentiments, how are you positioning the portfolio to balance conviction with caution?
Yeah. Hi, Rishmi. Thank you so much. I think it's an exciting time. We've chosen the right day to do this webinar. Markets are on a roll. So I'd like to start with a small quote from Ray Dalio. I think he mentioned that if you always keep agreeing to the consensus, then you'll never make money. And that's something we take very seriously at Sundaram because we have a contrarian way of thinking. And we have implemented that in our portfolios where we built in positions where markets were jittery regarding Trump tariffs or any of the negative news that has flowed in the last 9 months. And we have used this opportunity to actually increase our position in some of the bets. So today, if you look at the markets, we've seen a sharp recovery in the past 2 months. The first year, if you look at the 1-year return, it stands at 7%, which is quite similar to even the YTD return that we have. And earnings have at the same time undergone a downgrade cycle. If you look at the Nifty EPS, there's been an 8 to 9% cut in the Nifty earnings estimate for the current year as well as for the next year, while the markets at the same time have gone up by 7%. So this tells you markets have actually not gotten cheaper, but they've gone slightly more expensive than where they were last year. See, we started off FY25 on a very strong footing, expecting about a double-digit kind of an earnings growth for Nifty. But we ended the year with almost a flattish kind of a growth. So today, if you look at the current valuations, Nifty is trading somewhere about 22 times on a 1-year forward P, and at 19.5 times if you look at the 2-year forward P. Now, you may argue that valuations are quite rich. They look expensive because when you look at the long-term P multiple for Nifty, that's about 17 times 1 year forward. But there's an important point that we'd like to highlight. The composition of Nifty has undergone a significant change over the last decade. We've seen a lot of low P sectors like PSU banks, or some oil and gas companies, as well as some material companies have moved out of Nifty. They've been replaced by some of the secular growth businesses like insurance companies, some of e-commerce names, retail names, even some of the IT names for that matter, which have relatively higher P as compared to the older generation companies. So if we adjust for this, there has to be an adjustment of about 8 to 10% that one has to do to the long-term average. So we are not quite far away from that 19.5 times kind of an average that we'll come to. While we believe a lot of the earnings cut that the Nifty has seen in the last 6 months, they're largely factored in today's estimates, what we have seen. So when we go forward further 6 months from here, I think we'll roll forward to FY27 and you would realize that the markets are actually not that expensive. So our suggestion here to investors is it's more of a buy on dips kind of a market, and one should not really get over focused on the kind of multiples where the markets are trading. There are ample opportunities in different buckets to make money. At Sundaram, when we are analyzing the overall markets, we look at 3 different slices. The first slice is on the macro stability. I think we are in a quite a stable macroeconomic situation today. Number 1 is on the fiscal deficit side. The fiscal deficit has gradually been coming down. I think the government has, having a luck in their favor in terms of the oil prices coming down, as well as a big bonanza of dividend from the RBI. That has completely improved the fiscal situation. Number 2, there is a reduction in inflation. I think we are significantly undershooting the RBI inflation target. And with the current input or commodity prices where they are, we don't see that the inflation should see a very sharp rally in the next 1 year. So most likely will remain within the RBI target of plus minus 2% from the 4% number that they've put forward. And thirdly, on the central government capex side, markets were quite worried in the first 9 months that whether the overall full year FY25 capex number will be met or not, and the number was revised downwards. But come Jan, Feb, March, I think the government spent a lot of money on capex, and we actually overshot the revised estimate number. Even fast forwarding to say first month of FY26, I think the first month itself has seen significant increase in the capex number. It's never been done in the history. Almost 14% of the annual capex target has been met in the month of April itself. So we are on a strong footing from the macro stability side. Second layer is that we feel is on the corporate earnings side. I think a lot of cuts have already been factored in, but just to look outside the Nifty or the large cap earnings, the earnings are more widespread between the mid and the small cap sectors as well. So in our belief, we think a mid-teens kind of an earnings growth can sustain for the next 3 to 5 years for the overall corporate India segment as such. Now, this is driven by a couple of factors. Number 1, when we look at the RBI data on capacity utilization, that's running above 75%. It's an extensive data that captures information from 900 plus companies. So we can definitely rely on that. Number 2, the corporate balance sheets. I think they're significantly under-leveraged today. There's a lot of scope to re-leverage these balance sheets because stocks are running at very high P multiples. Even with minimum capital dilution, they can raise equity, as well as there is scope to raise debt as well. If you look at the current net debt to equity for corporate India, it's at a low of the earlier cycle at 0.5x. Even if you look at the overall corporate debt to GDP ratio, it's running at a cyclical low number. So there's ample scope to raise debt. But the companies we are not yet ready to commit to the capex. Why? Because the demand has to see an uptick as well. Where we are very positive that the overall consumption is likely to increase, both on the urban as well as on the rural side. Urban side, largely the story is going to be from the tax cuts, what the government has announced, which will start playing out in the second half of the current financial year. But interestingly, the rural wage growth is actually going to be higher than the inflation for the first time in the last 5 years. We've seen a significant abating of the inflation that is undershooting the RBI target. as well as there has been an MSP increase of 5 to 7%. So we'll see a continued wage increase of that 5% number for the rural segment. But because of lower inflation, they are for the first time in 5 years going to see a real growth. And the third layer is on the terms of risk capital that is flowing into the capital markets. Today, when we see the retail SIP number, it's at an all-time high of nearly 27,000 crores. This gives us a lot of confidence that this number of 25,000 crore plus number has sustained even in the toughest of the times. We've had a lot of negative news. There was a skirmish between India, Pakistan. There was a big sell-off by FIIs during the second half of last year, as well as there was constant earnings cut for the Nifty or the large caps every quarter. But despite all this flow of negative news, they have stuck to their ground and they have continued to contribute to the capital markets through SIPs. So we are quite positive that these inflows are likely to sustain and they're not going to see any slowdown in the near term. So essentially, your next question will be, where do we go from here? When we look at the earnings, when we look at the beats to miss ratio, they're still positive. Although managements are quite conservative, I would say, in terms of guidance that has led to a cut in the overall earnings estimate. But several sectors are actually driving this growth, largely consumption, industrial, cement, utilities. These are the sectors which are outshining and delivering the overall growth for Nifty. At the same time, there are some sectors which are disappointing. There was a lot of earnings cut we saw in auto, IT, pharma, as well as financials. So one possibility that we're looking is to look at sectors which are currently not part of Nifty and fall outside the broader large cap market that we see. And that's where we bring in our expertise because we are quite positive on the overall mid cap space. When people talk about the mid cap being more expensive as compared to large cap, I point them towards the earnings growth. When you look at the large cap companies, they're trading at 22 times 1 year forward for a 10% earnings growth. But at the same time, when you look at the mid cap index, they're trading maybe at 30 to 33 times, but for a 20% kind of an earnings CAGR. So we're actually 30% cheaper in terms of PEG ratio on a relative basis. So that's where we would suggest the investors to take a larger bet on. But it's not easy. It's like searching companies within the whole Nifty mid-cap space, which is a broader index of, let's say, 150 companies. Only 1/3 of the companies are able to deliver this growth. So one has to be quite focused in terms of identifying these companies, which can deliver constant earnings growth of 14-15% plus kind of a CAGR. Lastly, I think even in terms of all the trade tension and the news that we heard around the tariffs, things are actually gradually improving. I think India is close to signing the trade deal with Europe as well as US. The trade FTA with UK is already done, and we are on a much better footing as compared to where we were in the Trump 1 era. That should lead to a lot of improvement in India's global standing as well. So that's broadly where we are today, Reshmi.
Well, I quite agree because one of my second, third questions would come on this mid-cap earnings that you say that, identifying those bets in the mid-cap space. However, my second question, this is a very interesting insight that you gave. Darshan, my second question is to you now. Looking beyond the immediate horizon, which sectors or emerging trends do you believe are structurally positioned for long-term outperformance? And what fundamental or secular trends underpin your conviction?
Sure. Thanks, Reshmi. Thanks, Sandeep, for the opening remarks. I hope the audience is already hooked onto the session and is lacking the initial interaction. So if you look, every decade has delivered one large theme which did extremely well for that decade. So, for example, there was a secular bull market in India in the early 2000s, all the way up till 2007-8, which was that of infrastructure and general capital goods. And thereafter, post the change in government, we saw another bull run driven by consumption, which you saw in the 2010s. Now, interestingly, post 2014, we have seen that the government has done a lot of reforms in various areas of the economy. What it also means is that there has been increased innovation as well as use of technology across sectors. For example, the Jandan, Aadhaar, and the mobility trinity has helped drive technology and use of digital means across various parts of the economy. And what it has meant is that there has been increased competition across various sectors. What this in turn has meant is that the business cycles have gotten shorter and more volatile. They have become more volatile, and I mean a short cycle compared to the long business cycles that we used to see in earlier eras. So 2020s was interestingly a relay race, I would say, between multiple themes and which changed every few years rather than having one long decadal theme. Now, for example, I will just elaborate on this point. Post COVID, what we initially saw was a strong focus on healthcare and wellness. We saw the rise of diagnostic chains. We saw the rise of ensuring that we had all our basic needs in place. So, for example, therefore, consumer staples and healthcare did very well in the initial leg post COVID. But thereafter, once the government relaxed movement, and therefore it led to a strong unlocking led pent up demand, right, and which especially drove the consumer discretionary segments within our economy, and therefore those stocks did very well for a period of time. Now what happened was that after that it led to a very high base for many parts of such sectors, and therefore after that what we have seen is that there has been a slowdown on a high base, along with certain other reasons why they are not doing so well now. But what we have also seen parallelly is that the government has came out with incentives to localize manufacturing in India, as well as also improve infrastructure in various areas such as power, railways, electronics, and so on. Parallelly, what we have seen is the rise in geopolitical tensions across the world, and which has drove the strong interest in defense theme. Now, if you look at it in another angle, what you will also notice as the COVID and supply chain disruptions also forced corporates to become more efficient, not just in terms of profit, but also in terms of balance sheet. Therefore, we have seen that the corporates have not really used debt to fund their capex, if at all. They have rather leveraged the strong balance sheet and raised capital because of the good valuations that they have got in the capital markets. And in fact, they have been able to raise the capital they needed by diluting a very small stake. We have seen that there have been so many different blocks by PE promoters or the promoter families who have raised capital to fund their capex rather than resorting to debt. Uh, so therefore, in the short term, if you see, it's very difficult to determine which theme or which sector will drive the next leg of capital appreciation. As Sandeep already mentioned, I mean, the demand had been weak in the past few quarters and we saw earnings cut. The RBI has also taken several steps to relax the stringent requirements that it had imposed last year. It has also done a lot of rate cuts. We have seen a 100 bips rate cut cumulative over the past few quarters now. This has driven the market back to near all-time highs again. Now, what this means is that in the near term, with the rich valuations, you may feel that it is difficult to invest in the Indian equity market. However, if you slightly increase the scope of your investment horizon, if you were to have a 3 to 5 year view, there are several themes that are still available and I think are expected to do well over the next few years. So let me just take you through a few of them. So the first one, if you notice, is that of financialization of our economy. Now, what do I mean by that? In the 1970s, you would see that there were a lot of, I mean, it was mostly banks who would provide you basic products like, for example, savings and debt in order to meet your requirements. But now, what we have seen is that there are many more different types of financial products and services that are available. We have got, for example, the insurance needs met by our life insurance companies and general insurance companies. If we want any investments, we have a plethora of opportunities relating to either equity or structured debt and even complex derivative. So there are several sectors which support these kind of needs in our economy. Over the past 20, 30 years, all of them have grown at very healthy rates. Despite this strong growth in the past many years, they continue to remain underpenetrated. If you notice, equity investing is still concentrated only in certain parts of our country. It has not become democratized as yet. And therefore, there is still a very long runway of growth for many of these themes. So, for example, in investing or in equity investment, we have got wealth management firms, brokers, we have got exchanges, and we have got market infrastructure companies like the KRA companies who are available to us. Similarly, we have got specialized NBFCs now who are focused on a lot more specific niches of debt. So, for example, we have got auto finance companies, vehicle finance companies, we have got SME lending. There are specialized NBFCs who are very focused on one subsegment in each and are doing very well in their respective areas. Most of them start with one particular state and with one product, say be it a gold loan or a SME lending or a auto or a vehicle finance company, and they start out with one state. As they mature, they enter into new states, enter into even more number of states, and thereafter, once they have achieved success in one category, they take the learning from the same and add new products to it. Therefore, if you notice, in the past as well as in future, NBFCs are expected to do grow at a much more higher rate compared to the banks that have now become much larger and and they will find it difficult to grow at a higher rate. Uh, Financial inclusion has been one very big theme in the past decade, where with the Jandan Yojana and the Aadhaar stack, we have seen that there has been a revolution in the fintech space in India, and we have seen the rise of newer business models, like for example the payments companies. So we have got a few companies now which are listed, but there is a lot more innovation still happening, and a lot more companies will come into the Indian listed market over the next few years. Uh, Let me now take you through another long-term theme which we are positive, and that is that of the health and the wellness. As Indians progress economically, it also brings with it certain side effects. Now, the biggest side effect is that of we are now getting more and more into a sedentary lifestyle, and what it means is that unfortunately Indians are also getting more chronic ailments like diabetes or cardiac problems. That we should not have it, but that is the truth. And therefore what it means is that there is a strong demand for chronic drugs, or you can say even services relating to the same. One of the themes that we remain very positive on is that of the hospital space. So for example, we now have a variety of hospitals, some focusing on certain segments like oncology or cancer treatment. We have got hospital chains which are treating eye care, disabilities, or for example cardiac challenges. So there are a lot more hospitals and which are super specialized on certain treatments. India is also becoming a very big destination for overseas medical patients who want to get themselves treated at lower cost. So medical tourism is becoming a big growth driver for these hospital chains. The third theme that I would like to take you through is that of outsourcing of non-core activities. Now, what do I mean by that? If you notice, Indian IT companies build their entire business models and have become large by outsourcing of the traditional IT work, which was outsourced by the US and the European corporates. But what we are now seeing is the rise of newer forms of outsourcing. What do I mean by that? If you must have observed, India has a very large population of almost 1.5 billion people. Now, these people, our younger generation, is all very academically oriented. All of our previous generations, we have all come up the hard way and studied. Uh, we have been good in our basic sciences. So India produces the largest number of engineers and medical students every year, and these are getting absorbed in newer business services areas. For example, we have got the likes of pharma research and development organizations. We have got the engineering research and development companies which have come up the curve and are now providing value-added services across the globe to global innovator companies. Like for example, in pharma, you have got the likes of Bayer, Johnson and Johnson, Eli Lilly, Novo Nordisk. Similarly, in engineering and auto, we are having companies like KPIT, Tata Elxsi, which are providing value-added engineering services to the likes of BMW and Mercedes. So what we are seeing is that there are several new different types of business services which are attracting the talent in India and are providing value-added services across the globe. Now, also one the interesting trend that we are seeing is that of the global captive centers. Now, this is a very new concept. What is happening is that India is becoming an office to the world. Now, what do I mean by that? It basically means that for a variety of other functions, for example, legal, human resources, uh, financial back office, Indian companies are either providing services to these MNCs, or the MNCs are setting up private global captive, their own captive arms in India. Now, how do we play these kind of companies? Now, there is no direct GCC play, but there are. I mean, it is providing a positive momentum to other ancillary companies in the Indian market, which is that of, say, real estate companies or of co-working spaces and so on. So what we are noticing is that there is significant interest and significant newer forms of opportunities which are now available for investors in India, and these are very long-term structural themes. I spoke about the pharma R&D space. We have seen that earlier China was the biggest beneficiary of the research outsourcing work. Now, gradually, Indian companies are coming up the cost curve. The Indian scientists are much cheaper than the global counterparts, and are also providing even they are even cheaper than, you can say, the Chinese scientists, and therefore incremental business is now getting benefited to the Indian CRDMO companies. I would take a pause here, and I would ask Sandeep to cover some interesting contrarian themes that we are also positive on.
Hey,
Thanks.
thanks, Darshan. Definitely appreciate your views on that. I also have a couple of sectors where I'm quite positive, of course. Agree with most of the things that you said. But one sector where, I have been very positive of late is the capital goods sector. Now, I've tracked this sector for more than 15 years, and the first 10 years out of 15, definitely the sector is underperformed. So I think definitely it's had its time now to shine in the glory. But yes, one big mistake that a lot of investors make is they paint the whole sector the same brush. Everything is capital goods. Everything is going to do well. I don't think that's the case. Having looked at it closely, there are various sub segments of capital goods. One is of course power. There's defense. There's railways, EMS, industrials. There's various sub segments within that, and we like quite a few of them. But we are today the most positive on power sector. We think each leg of power is likely to see significant investments over the next decade. And because of the turbulent past that the sector has had, there's not enough capacity to cater to this future demand. Means the existing players or the incumbents are likely to see a much faster growth. And just to run you through a bit of a history, if you remember 10, 12 years back, we used to see very high power shortages in India, running in excess of 15%. If you look at the current numbers, in fact, last month during May, on 1 hour, particular 1 hour, the prices on the electricity power exchange had hit a low of almost 11 paise a unit. Essentially, there was too much power in supply while there was not enough demand in that particular 1 hour to do the offtake. But we think there's a 6-7% kind of a GDP growth with a multiplier effect. It's going to result in about 7.5 to 8% kind of power investments in the country. And there's not enough capacity which can cater to this acceleration or increase in the power capacity today. So just to give you some broader numbers, today when we look at the India's power capacity, it's roughly about 470 gigawatts. Nearly 50% of it is thermal, and balance 50% is non-fossil fuel. Now, what has happened in the last decade is solar prices have gone down by about 65 to 70% in terms of modules and cell prices. But the installations have gone up by about 40 times. If you look at the 12-year-old number to today, the overall solar installations have increased massively. But despite that, when we look at the overall power demand that needs to be met on a round-the-clock basis, that's not being met, because essentially you generate solar power during the day, but the evening peak hours still need to be met by the traditional thermal power plants, which is coal and gas, which is where a lot of underinvestment has happened. So the first theme that we play within power is the generation piece, where because of past underinvestments, a lot of companies have gone out of business. So the surviving players are right now reviving their capacity, and they're taking up a larger part of the overall investment pie. The second leg on the power capex side is the transmission and distribution piece, where a lot of underinvestment has happened in the past decade. The thumb rule says if you spend 1 rupee in generation, you have to spend 1 rupee on T&D as well. But in the past decade, that number has been 0.6. So it has been underinvested by 40%. Now you would ask me, so Why should it pick up now? There's a very strong reason behind that. The renewable share of the overall power generation has increased materially. And when you look at the numbers going forward in the next 5 years, bulk of the capacity addition, more than 70-75% of capacity addition, is likely to happen on the renewable side. Now, as this power is not generated round the clock, they need a smarter grid. They need certain kind of investments which are specialized in nature to evacuate this power from one part of the country to other part of the country. As well as there is latency and other technical factors which need to be taken care of, which can be done only by specialized company. So when you are investing in companies with these kind of specialized skills and equipment that they can provide, definitely I think investors are going to make a lot more money. And not just on the upstream transmission side, when power reaches the final leg of consumption, there's a lot of investment in downstream products like smaller transformers, cables, wires, UPS, things like that. So within that space, also there are several companies that are aggressively investing in capacity. And given the economics where we are, I think these capacities are going to give them much higher ROIC than a company which is entering the sector now and wanting to take a piece of that. So I think the incumbents are going to take bulk of the market share and return ratios over here. And the third piece on the power capex side is the exports. Now, we are not generally very bullish about the exports, but within a particular leg, we are seeing this overall dearth of power capacity is happening globally, where we think certain companies who are in the non-traditional, non-coal, non-gas, the larger gas power plants, kind of an equipment what they manufacture, these specialized equipment manufacturing companies are likely to benefit out of this trend. Essentially because AI is gobbling a lot of power globally, and there needs to be credible power sources in addition to the traditional sources, which can bring up this generation capacity. So those are the three legs in power where we are positive. Outside of power, the second sector where I'm quite bullish is the Indian consumption trend, not the staples, but the discretionary piece of it. Reshmi, I'd just like to run you through a small story on this. Now, just imagine there's a Mr. Sharma who's a mid-level IT manager in a company based out of Pune. 10, 12 years back, what do you think he must be doing on his weekend? He'll walk out to the local grocery store. He'll do some bargain hunting on onions and potatoes, right? That used to be his pastime. Fast forward to 2025. What is he doing? He's picking up his mobile phone. He's scrolling on some fashion feeds. True, right? Fashion feeds on Myntra. He's ordering some food from Swiggy, Zomato.
At his doorstep, at a beck call, things are there. Just 2 clicks.
Exactly. And he's also able to book a short getaway holiday for his family. All of this has become quite easy and on a click. Why? Few reasons here. One is there's a big jump in the per capita income growth, and there's a participation of women in the workforce. So the disposable income of the family has actually gone up. Secondly, there is digital access. You have cheap internet, as well as you have a robust payment system in form of UPI. That has actually led to this whole proliferation of digital economy. So we are investing in 3 pillars of this whole consumption trend. First is on the retail side. Today, when you look at the retail spends that Indians are doing, it's the third largest market in the world, and which has a more than 12% kind of penetration. Now, within this, 40% of spends are happening in tier 2, tier 3 towns, not just tier 1 and metro towns. So a lot of spends is actually happening outside the major cities. The second pillar is on the e-commerce side. Today, e-retail GMV, or the gross merchandise value, is about $60 billion. There's some near-term slowdown that we're seeing in these spends, but we think these are going to pick up as urban consumption improves, and we estimate this number to become at least 3x in the next 7 to 8 years, seeing an 18 to 20% kind of CAGR. And the third leg of that is on the hotels and hospitality side. Now, the occupancy and the room rates in tier 1 cities have seen a significant increase in the ARRs, or the average room rates, because post-COVID, there's been a significant change, and the amount of hotel capacities that were planned is actually much lower than what the supply was. So this is going to be a consistent trend in our belief. I think the overall demographics is getting better. That is, 65% of India's population today is less than 35 years of age. They are all internet savvy, mobile phone savvy. They're going to spend more online. And secondly, as I mentioned, you have easier access to credit as well as the payment infrastructure. Today there are more than 80 crore users who use UPI in their phone. So that's going to increase the overall digital consumption and the overall consumption story that we are going to invest in. So that's where we are. We're going to move from, I think, kirana counters to cloud kitchens in future. That's what we're going to do.
Correct. Wow, what a lovely insight. I mean, yes, to be thought about. I mean, when we talk about sectors and all, consumption story is really something insightful. And I quite agree with what you say. Very, very interesting insights indeed. So, coming back to my third question from this, which is a fallout from the last two, we have historically seen, in fact, if you remember, I told you that we've historically seen that one third of the markets outperform the broader benchmark. To take this concern ahead, are there any industries or sub-segments which you would like to currently advise our investors to be underweight on or avoid altogether? Now, what are the don'ts? I want you to talk about the don'ts. And what risks or headwinds do you foresee?
Sure. So thanks, Sandeep. That was really insightful, especially the consumption part of it.
Correct.
So Reshmi, we also have to understand that fund management is not just about like picking the right winners and just going along with it. Risk management is an equally important part of investing in your own personal capacity as well as for professional fund managers like us. So, as important it is to identify sectors and stocks that will do well in the short term, in the long term, it is equally important that you also avoid certain sectors and stocks that face headwinds both in the short term and the long term. So, portfolio resilience is not just about winning, but it is also about avoiding large losses in the first place. So, if, for example, deeper the drawdown, exponentially harder it is about the recovery. For example, if a stock falls down by 10%, 11% appreciation means you are back to square one. So you are back to zero. You are back to square one. But if it is a 20% drawdown, it requires a 25% appreciation. And if it is 30% drawdown, then 43% capital. So you understand it's just a 10% additional fall, but the additional recovery that you need is actually going up exponentially. So that is what I am trying to highlight here. Now, India is a growth economy. Many sectors will do well, but there are certain themes that will require caution, and you will need to maybe either avoid or you need to be very opportunistic about. So I will just give you some highlights, and I think Sandeep alluded to some of it in his remarks as well. So, for example, FMCG companies in the Indian listed market space, if you see, most of these FMCG companies have become very large. They have become sizable in terms of revenue and profit pool. They used to have a very strong hold on the distribution channel till the time it was dominated by the general trade. But now we have seen the rise of modern trade, e-commerce, quick commerce, 10-minute delivery platforms like Zepto and Blinkit. What this has meant is that we have got new competitors who can now address a larger market and a larger customer base through these kind of channels, and therefore are like competing head on with these large listed companies. If you see the growth rate of most large FMCG companies, you will see that their growth rates have been in single digits for the past many quarters, many years now. In fact, at the same time, what is also happening is that they, because of their negative working capital cycle in the past, they used to enjoy very good return ratios and used to enjoy high valuation multiples. But therefore, if you see the rise in competition, the rise of D2C brands, local regional brands who are now able to compete on a equal footing, their growth rates have moderated. To get back that growth rates, what they have had to do is compromise on margins. So therefore, what is happening is that the earnings growth for FMCG companies has become structurally challenging to be in double digits. You can say they will grow. It's not that they are not going to grow, and there will be periods when they will do better. But on a structural basis, the growth rates have like become low, and I would say low to high single digits at best. And given the context of their high valuation, it becomes difficult to generate alpha from this space. Similarly, another angle is that of IT services companies. I already highlighted in my earlier remarks that, I mean, for a very good 30, 40 years, the Indian IT services companies grew at very high double-digit rates, became very large. They are now among the top 5 to top 10 globally in terms of their revenue size and so on. But if you see now, what is happening is that the trend among the client base of IT services companies is more of digital, smaller deals, and where smaller and mid-cap IT companies are now able to compete on a equal footing. They are able to get those businesses by being aggressive on pricing, which is putting a pressure on the realization of the traditional large IT Indian IT companies. Another very important aspect is that of AI. The rise of generative AI and other newer forms of artificial intelligence is putting pressure on their entire business model, and they are being forced to reevaluate their entire businesses strategies in total. What this again means is that, I mean, nobody has a good handle on the growth sustainability of the, especially the large Indian companies. There are specific mid-cap IT companies which continue to do well, and we have positioned our portfolios accordingly. Another example I would like to highlight is that of PSUs and PSUs in India. The government has rightfully asked them to focus more on growth, clean up their balance sheet, become a bit more aggressive. But at the end of the day, we have to understand that, I mean, the government companies are also bound by certain regulatory challenges, and therefore, I mean, cannot be as dynamic and active as, say, the private counterparts. Nevertheless, there have been some select PSUs, like for example SBI, which has done very good. But I mean, on a as a theme, PSUs find it a bit difficult to grow at high rates. Another interesting, again, it's more on the large cap side as well, is that of banks. Now, if you see, the large private banks in India have become so large that for them to grow sustainably on a in a high double digits is bit of a challenge because of the base itself.
Hmm.
Most mid-cap banks are on both private as well as PSUs are also facing challenges as far as growth is concerned. We have seen every private bank is facing some segmental challenge. So, for example, we have got IndusInd Bank, which has been a bit challenged with microfinance loans. Similarly, Bandhan Bank has also gone through a painful period because of its microfinance exposure. Similarly, there are other banks which, because of regulatory reasons, cannot really compete on an equal footing with some of the specific NBFCs. So, therefore, for them also to grow on a at a high rate on a sustainable basis becomes a bit of a challenge. Finally, we have the likes of, for example, oil and gas, commodities, metals, which again are dependent on not just their own internal factors, but also have to face global factors. For example, a steel company in India has its realization and margin are also dependent on what Chinese steel industry is doing. And therefore, I mean, if China decides to become aggressive in its export market globally, then the Indian steel companies come under a bit of pressure. The government is taking steps to improve the competitiveness of our various industries, but I mean, these type of companies and sectors remain challenged by certain global constraints. So our point is not to say that these are uninvestable companies, but these are therefore, I mean, structurally challenged to grow at healthy double-digit rates is what I would point out. Opportunistically and tactically, from time to time, they will provide very good trades, and we always have a certain part of our portfolios that we allocate to opportunistic and tactical ideas, because these are not uninvestable, but it's just that from a structural long-term point of view, these become a bit difficult to be invested in for the long term. I would hand it back to you, Rishmi. Thanks.
Thanks. I mean, so in a word, in a nutshell, I don't know, correct me if I'm wrong. You meant to say these would be a draggers in a typical portfolio as of now, looking at the current scenario. So one must typically avoid this in terms of generating a
They can be a part of your portfolio, but I mean, you need to have the margin of safety in place,
correct,
and
correct.
you need to be sure about the cycle. At the end of the day, many of them are cyclical sectors, and therefore you need to time your entry properly in these
Hmm.
kind of sectors or stocks.
Very interesting, Darshan. Thank you so much for these insights. To conclude, what I can perceive from the entire conversation is that Indian markets remain ripe for investments, provided the concoction is right. I mean, we have a long term capital appreciation, say invested for a longer period of time. And while we also overlay with the structural bets, with the opportunistic bets. So that's a perfect concoction of long-term structural bets along with the opportunistic bet. That's what you are actually advising our investors. So with that, yes, thank you for these wonderful insights that you've given. I think we should be opening our podium for the questions, Q&A. Over to you, Arvind.
Yeah, thanks for the very insightful and deep conversation, ma'am. I must say there is a lot of takeaway from your conversation. Dear participants, the forum is open for Q&A. You can post your questions in the Q&A box. So the first question is, what are the key market signals you are currently tracking that others often overlook?
Some of the key market signals that we generally keep a track of is that of, for example, what is the RBI doing in terms of its rate cuts, the various reforms or relaxations that it is doing with regards to specific sectors as far as the NBFC space is concerned. Thereafter, I mean, we keep a track of the various macro indicators that get published on a monthly basis or on a quarterly basis. So, for example, the capex utilization of the RBI, the incentive schemes. So, as our team, we have a 5-member research team, and each member is tracking sectors of interest that we like, and therefore each of us is tracking relevant sector indicators, and there are a plethora of indicators that are available. So that is what we do.
There is a question on infrastructure and capital goods have been major outperformers. So is there still room for alpha in these sectors, or has the money already been made in the space?
Yeah, I'll take that one. So capital goods essentially, of course, has been a stellar performance in the sector that significantly outperformed the broader market index. But as I mentioned, when one looks at this sector, infrastructure is something where we don't still see that kind of positive indications. But essentially, on the capital goods side, one should not look at it under the same lens because the sector has several sub-segments within that. So there are some segments which are doing well, as I, of course, elaborated a lot on power equipment. Similarly, there's a story on, say, defense or electronics manufacturing that is doing well and will continue to do well. I think there's a lot of long-term growth rate that's still embedded into the sector where capacities are still not fully utilized. There's a lot of movement and localization happening of manufacturing of these equipment here in India. So that's more than a decadal kind of a growth that we'll see in these sectors. But on some of the other side, the core industrial sector side, until unless we see a significant ramp up in capacity utilization, or the companies which are catering to more of a consumable kind of a growth rate, where you see replacement of existing equipment, constant utilization of the consumables, that is the space where I think will relatively underperform as compared to the traditional capital goods companies, which provide equipment for new projects and newer capacities. That's what I would say.
Sir, can Mr. Sandeep reiterate the point of how the change in composition of the index translates into reasonable trailing PE rather than expensive? There's a question to you, sir.
Sure. So essentially, what I meant to say here was when you look at the Nifty composition, the long-term PE average is 17x, while it is today trading at 22 times. But the older composition of Nifty had a lot of PSUs in the banking side as well as on oil and gas, as well as some material companies which are not part of the index currently. They have been replaced by some of the secular growth sectors like insurance, e-commerce, and retail. So these companies have a relatively much higher growth rate and a secular kind of a growth rate going forward. So when you adjust for that, the low P moving out and the high P companies coming in, there can be an 8 to 10% kind of an adjustment. And you should look at the Nifty's overall earnings multiple, that is P multiple, with the same lens, with this adjustment. That's what I was highlighting over there. So maybe 22 times is maybe 20 times right now and not 22 the way you should look at it.
What role do alternates play in capturing sector-specific alpha that traditional funds like mutual funds may not? There's a question on alternative investments, sir.
Okay. So let me have a first go at the same, and thereafter, if Sandeep wants to add. So see, first of all, alternates. I can speak on only for the equities as well. Basically, we invest in a concentrated set of portfolios. So our portfolios would be at best say of 20 to 25 stocks, or even lesser. we are very focused on certain themes that we like, and therefore are able to take larger weights on the same. Whereas if you look at the traditional mutual fund across market cap categories, they are having a very long tail. In the past few years, you may have noticed that the number of stocks in a mutual fund portfolio would go all the way up to 100, or even in some cases 200 also. Now, in the past few years, mutual funds have benefited because of the strong liquidity in the market, and therefore you will see that the long tail has also performed. But as Sandeep highlighted in his earlier statement, what we are seeing is that the earnings growth is now getting narrowed to a specific sub-segment of the market. If, for example, in Nifty 150 index, only around say 55 to 60 stocks are continuing to demonstrate strong earnings growth, whereas the majority of the mid cap and the small cap stocks also, the earnings growth has decelerated, and therefore it makes sense to now have a more focused approach to investing. And that is where I think alternates differ from the mutual funds, where alternates in general on the equity side will run a concentrated portfolio focused on high growth segments within each sector, and accordingly over a period of time they will continue to do well. The other thing was that because of the strong liquidity, we were seeing that value had done very well in the past few years, and you have seen that many cyclical companies as well as poor quality companies also went through a period of re-rating. What we are now seeing is a mean reversion to quality again, and therefore what we are going to see is that quality is making a comeback. Growth plus quality is making a comeback, and therefore you will see that concentrated, quality-oriented portfolios bought at the right valuation multiples will deliver much better alpha compared to a long tail oriented portfolio.
So there is a question on with rising digital transformation across industries. Are there any niche technology or new age sectors you believe are currently undervalued?
Yeah, hi. So of course, we are quite positive on some of the sectors where, I mean, even we are searching for specific plays in digital transformation of several sectors where the themes can actually benefit investors. It's honestly very difficult. Like if you want to invest in, let's say, an AI company today in India, it's very, very difficult to find that kind of a play within the listed space. So how would we play it? We play it indirectly through a company that manufactures power equipment for running data centers, for the companies who are providing real estate as well as equipment to install a data center. So that's how we are playing this theme currently in an indirect way. Globally also, there's a lot of investment happening in AI, and there's been a constantly technology change. So some of the IT companies who are on the ER&D side, that's where a lot of investments will be moving in, and that's a space that we evaluate to invest in. But in terms of direct play on AI and some of the future digital transformation themes, I would say there are very limited plays today in India.
Can you stretch on big bonanza dividend part? I think they are asking about the RBI dividend, sir.
That actually, so RBI has given a dividend of 2.7 lakh crore last year, which was a big jump over FY24 number. So that is the one I was referring to. And that is a number that was not expected by the market. So it was much higher than what the market was expecting. So that was the number that I was referring to in that question, in that piece.
Oh, thanks, sir. What's your outlook on inflation, especially core versus headline? So they are asking some perspective on inflation, sir.
Sure. Darshan, would you like to take that?
Yeah, please go ahead.
Okay. So on inflation side, actually, the outline that I was giving is that the current numbers that are sub 3% is actually much lower than the target that was set by RBI at the start of the year. So target that's set by the RBI is around 4% inflation for the full year, and the GDP growth rate is expected to be somewhere around 6.5%. So inflation numbers are slightly undershooting. We think the overall there's an expectation due to this there will be less pressure in terms of the wage growth, the real wage growth for both the urban as well as the rural side, which should propel some more amount of consumption and spending on that part of the economy. So in our view, we think there's an upside to the current GDP growth rate that's expected. And inflation, at least in the near to medium term, we don't see this number shooting above what the RBI's overall target or guideline in terms of the inflation number of 4% is.
Just to add, I mean, for example, there was a scare in May and in June where, because of the wars, there was an expectation that the oil prices may go up again. Fortunately, for global as well as us, We have seen that the ceasefire has been in force now, and therefore the expectation that oil prices will go higher, that has also gone away, and oil prices have come back below $70. So therefore, I think the inflation numbers in the future should continue to moderate downwards.
Oh, gotcha. With major central banks now approaching end of their tightening cycle, how do you see global liquidity trends impacting Indian equities, especially mid and small caps? There is a question on mid and small caps, sir.
Sure. Let me take the question. So if you notice, from a foreign institutional investor point of view, in fact, interestingly, they withdrew money from India for the past, especially post September 24. And you saw that, there was a sharp correction, especially in a small and mid cap side. Now the FIIs have started to make a comeback. Also, what we are now noticing is that the global central banks have started to cut rates. So, for example, Swiss central bank was the first one to go through a cut. Thereafter, other central banks have also started doing it. India also went through a cut. It is the US Fed which remains. It has been going through a shallow rate cut cycle, and more cuts are expected down the line. Uh, so all of this means that the liquidity will first of all improve, and it will start chasing risk assets, which means that it will be positive for India. Traditionally, FIIs have been focused more on large caps in India, but now what we are also seeing is that FIIs have also become smarter in their investment, and there are many FII funds which are more interested in mid and small caps as well, the good quality ones, and therefore we will see an increase in the FII flows, especially towards mid and small cap. And interestingly, they are I think at the recent lows of around 18% of the market. So it is a matter of time before they again go back towards, say, upwards of 20% or more. And that would be again a positive development, especially for small and mid caps in India.
Okay. So, what is the future that you foresee for electric vehicles in Indian auto industry? There is a question on electric vehicles.
Sandeep, you want to take it?
Yeah, go ahead, Darshan, go ahead, please.
Okay, sure. So see, electric vehicles, we have seen that post the PLI schemes, as well as various government incentives, especially from the state side as well. So many state governments came out with additional incentives over and above the central government schemes. What we saw was that there was an increase in the penetration and more adoption of electric vehicles, especially on the two-wheeler side. So first of all, we saw a rise in the number of players in the electric two-wheeler space. Many unorganized players basically importing the various parts required in an electric scooter and assembling it in India, and thereafter selling those electric two-wheelers to the Indian market. And therefore, we saw that the percentage of electric two-wheelers in the overall scheme of in the overall two-wheeler industry rose from 0% all the way up to 5 to 6%. From here on, we have seen that they have not really increased. It has been stagnating at around this percent. Why is this so? Because the government clamped down on illegal and poor quality electric two-wheelers, and it resulted in the stronger, more organized players gaining market share, now becoming the more dominant ones. So, for example, earlier you had several names, like for example, a Hero Electric or some really unknown names which were dominating the space. But now, if you notice, it is dominated by mainly three players, which is Ola Electric, TVS Motors, and Bajaj Auto, with their respective brands, and each one of them is having a market share of around 22 to 25% each. And therefore, the top 3 or 4 players are now almost 80% of the electric two-wheeler space. On the four-wheeler side, adoption has improved, but it is still not to the extent of, say, what is we have seen in the two-wheeler space. And that is because, of the charging infrastructure, which is still not up to the mark in India. For many places, even in cities, we will see that there is lack of charging infrastructure, and which forces consumers to continue with their ICE vehicles. In terms of the component supply chain, India is localizing a lot of components which are required in an electric vehicle, but the critical parts, which is that of the battery, we are still dependent on China. And the government is giving PLI incentive schemes to the battery manufacturers and the cell manufacturers to localize that as well. But it will take time. In the meantime, what we have also observed is that there are certain use cases where ICE remains relevant. For example, in hilly regions or in high load bearing capacities, you will see that the diesel or even a petrol vehicle will remain relevant. So therefore, I think it is over a period of time, you will see a stability in the market share between electric and the ICE vehicles. Uh, Indian companies have taken the lead. For example, we have got Mahindra and Tata Motors, which are dominating on the four-wheeler side. They have came out with some really fantastic products which are being accepted very well by the Indian consumer, and you see a lot of electric vehicles on the road, both on the two-wheeler as well as on the four-wheeler side. So localization will be a theme going forward, but it will take its own sweet time. There will be challenges and hiccups along the way, but I think over a period of time you will see that electric vehicles will make headway and will become a crucial part of the Indian auto space.
Yeah, thanks for it, sir. I think we are done for the session, ma'am. Remaining questions we will share it with you so that your team can answer, ma'am. Darshan sir and Sandeep sir, thank you for sharing your insights in this session. I must say it's really very interesting and very deep dive conversation. We have enjoyed it thoroughly. Thank you, Rashmi ma'am, for your presence in our session.
Pleasure is
Thank you
all
so much.
ours. Thank you,
Thank you.
Darshan. Thank you, Sandeep.
Thank you
Thank you
Thank
all.
you,
so much.
viewers.